Welcome back to FX Street. It's 8:01 a.m. Eastern. My name is Rosen. Welcome, one and all. Great to see everyone here. Thank you for joining us. We have a very fun webinar to talk about today. We're going to talk about two, pretty commonly used indicators. Number one is the Bollinger Bands that you should see at the top of your screen. The screen should be sort of cut in half. Top half of the screen, you should see candlestick chart with the Bollinger Bands, these white lines that sort of track the market's progress. And at the bottom, you should see this blue line going up and down, and that's the ATR, the average true range. And I'm going to go through exactly what each indicator is looking for. Excellent. Thank you very much. The Bollinger Bands on the top end of the chart, this is something we talk about a lot, but we'll go back and talk about it a little bit more. The Bollinger Bands, the center line is a 20 simple moving average. It's a 20 SMA. Now, the two lines above and below the 20 SMA are that SMA, that simple moving average, extended 2 standard deviations above and below the center moving average. 2 standard deviations is designed to capture around 95% of the market's trading activity. So logically, we'd expect the market to go above the upper band only about 2.5% of the time, and below the lower band only about 2.5% of the time. 95% of the trading activity should take place within the Bollinger Bands. Now, logically, what we would expect if we see, hey, if the market is going to be between these two Bollinger Bands most of the time, logically, we want to buy when we cross below and back above the lower band, and sell short when we cross above and back below the upper band. That makes sense, and traders will usually, furthermore, take profits in the center, because the market logically has the greatest chance to return to the simple moving average, the center of the trading range. Some traders will buy the lower band and sell at the higher band, trying to capture this higher move. It's a lower probability trade. Doesn't mean you can't make money, but we want to try to make money the easiest way possible. Now, that's the Bollinger Bands. The indicator at the bottom is the ATR, average true range, and what it does is it measures the average range on, well, this is a daily chart, so the daily candlesticks. If this were a 4-hour chart, we would measure the 4-hour candlesticks. But looking at the daily chart, what we do is we measure back 14 periods, 14 candles, to establish what is the average trading range. So if you look at the line, currently, we're looking at a level of around 168. That means, according to the ATR, the average true range of the pound-dollar daily chart is around 168 pips from bottom to top. Now, if you actually look at the calculation of the ATR, it's a little bit more complex than that. But that is what the indicator is designed to do. Now, like the entire definition, there's, well, you can look on Google. I know stockcharts.com has a very good definition, the actual mathematical definition of the ATR, and a lot of the other indicators as well. It's www.stockcharts.com, by the way. It's a great site. But aside from that, what we're looking for is an indication, is the ATR rising or declining? Now, when does the ATR rising or declining, when does that occur? Well, if you look back at this chart, going back to around October, November, actually about October of last year, 2008, we saw the ATR went to a very, very high peak, actually hitting levels around 496 or rounds to 500. That means the average true range of the pound-dollar daily candlestick was about 500 pips from low to high. Now, moving forward, that quickly sold off to levels around 238 from October of last year to December of last year. So in the last 2 to 3 months of the year, the average true range of the pound dollar dropped from 500 pips per day to around 238 pips per day. Now, how does that help us? How do we use it with the Bollinger Bands? Well, very simply, let's take a look at something a little bit more recent, and we'll try to identify what we're looking at. But theoretically, before we look at the charts, theoretically what we're looking to do is, remember, the Bollinger Bands are designed to capture 95% of the market volatility, now market action, I should say. Therefore, I want to buy low, sell high. That approach in range-bound markets, markets that do not make new highs and new lows, that approach tends to work very well. We buy low, sell high, over and over again. I hate to sound like a commercial, right? It's channelingstocks.com, but it really does hold true. However, the downside to the indicator, and I think every technical indicator is limited to an extent, and it has its own inherent downside. The downside to the Bollinger Bands is that we can see previous times in the chart during October of last year, before this ATR hit its peak, the market was breaking down to new lows consistently. And if we were to buy the pound dollar as it hit the lower Bollinger Band, September and early October of last year, we would have been very, very wrong. Buying the pound dollar near the 170, 167 level, but we can see very quickly it sold off to lows 152. Literally within a couple trading days, the market sold off 1,500 pips. We're either going to get stopped out, we're going to get margin calls, or we're just not going to make money on it. So we want to avoid those trending market conditions. A range-bound market occurs when the market fails to make new highs or new lows. Let me draw a couple, whoops, that's not it. Let me draw a couple lines and I'll show you what I mean. Taking a look at the chart, we'll make this line nice and red so everybody can see. That is a range-bound market right here, this little pocket. And what we're looking for is these pockets where the market tends to slow down, when the ATR starts to decline. And you'll notice that if we correspond this to the ATR declining, we can see, well, the ATR hit its peak around 500 and started to decline. It did not happen immediately, but eventually as the ATR continued to decline to the downside, and the beauty with this approach is you can miss trades. You don't have to get in too early. In fact, I think it's probably advisable that you really wait for confirmation. But we can see that the market began to slow down. As the market and the ATR began to slow down, smaller candlesticks mean range-bound markets. Range-bound markets mean the market has less of a chance to break out to new highs or new lows. And that is a signal that we want to look for when using the Bollinger Bands and ATR combination. I'm going to make these lines red as well so everyone can see. Please let me know if you can't see the charts, by the way. So we're going to try to circle or at least identify what is the range-bound markets. And this little box over here, surrounded by the horizontal and vertical red lines, is the ideal range-bound market. Notice how the ATR already began to sell off to the downside while the market began to trade in the trading range. And that is essentially what we're looking for. Now, there's an extension to this strategy, and this is what I want to show you. I'm going to take away the horizontal lines just to make everything perfectly clear, but we're going to leave the vertical lines on. And what we're looking for, in fact, I'll take away the second vertical line. What we're looking for is the market to begin to find a new low. Not a new low, a new low on the ATR. We're looking for the market to find a period of time when it's slowing down, because I want range-bound markets. I want to literally just buy low and sell high over and over again. I don't want to worry about the chances of a breakout. How do we identify that? Well, what I would do is, first off, I would go to the ATR itself. Let's go back to something a little bit more recent, where you can see over here the ATR line was increasing to an extent. And it developed some sort of support level. Now, I don't know exactly if this is the way it was intended to work, but we'll use it anyway. And we can see here the ATR crossed below this little support line that I drew, the little white line, if everyone can see, right about here. And here represents April 3rd. Before that, the ATR established a trading range, or indicated trading range, I should say, around 200, 250 pips from low to high every single day. Again, the calculation is a little bit more than that, but just to keep things simple, the ATR measures the average trading range of the candles over 14 periods. Keep in mind also that we're looking back 14 periods, so the indicator is going to be a little bit late. It's not going to catch, it's not a leading indicator, so to speak, but yet a lagging indicator. In fact, if you were to ask me, I'd tell you that I think all technical indicators are lagging by nature. Leading indicators are fundamental in nature, meaning we have a leading indicator like the jobless claims. The jobless claims leads into what could be a good or bad non-farm payrolls. The unemployment rate, not the unemployment rate, well, the unemployment rate also, but the CPI, the consumer price index, the producer price index, inflation numbers could be considered leading indicators into maybe a Fed meeting, because the Fed, the FOMC, watches these inflation numbers in order to adjust interest rates. We're getting off track though. Getting back to our lagging indicators, our technical indicators, we see here the red line marks off the point when the ATR then dropped to new lows. If this blue line represented the stock market or a foreign exchange currency pair, we'd say, hey, we broke to new lows. Something has changed. Something has indeed changed. The average range has very much decreased. Now, what I want to do at this point moving forward is then look to our Bollinger Bands. Why did I erase the Bollinger Bands? There we go. Okay, so we can see here the Bollinger Bands encompass, again, the low and high of the trading range. But this is a daily chart. What I want to do is step number one, and I'll write this down so everybody can keep track. Step number one is identify on daily charts declining ATR. Okay, that's number one. Step number two at this point would then be to go to a smaller time frame chart. I'm using a 4-hour chart. Some traders may use a 1-hour chart, a 15-minute chart. I like to use a 4-hour chart, so I think it's a very nice compromise. Now, number three, from that point moving forward, then what we want to do is use the Bollinger Bands in a typical buy low, sell high approach. I'll type that in. There we go. Okay, so remember, the red line on the daily chart marked off the point in time, and I'll go back to the daily chart so everyone's clear, when the ATR broke to new lows, and this tells us the market has really begun to slow down. Range-bound trading is the way to go. Going to the 4-hour chart now, we can see here, hey, this is the same red line, the same date. We're going back to April 3rd, and then we can use the Bollinger Bands to use a very simple buy low, sell high approach. Buy near the lower Bollinger Band, just to give you ideas of what the prices look like, we see our double bottom pattern right around 146. We then see the market break above the upper band, eventually going up to 150. Now you say, well, if I'd sold on this upper band, that would not have done very well. Well, there's an extension, and I'll zoom in a little bit. There's an extension to the Bollinger Band approach. Keep in mind that we don't want to just place a sell order at the upper band or just place a limit buy order at the lower band. I don't think we can trust the market so much. What we want to do with the Bollinger Bands is wait for the market to cross above and back below the upper band. So it requires a little bit of candlestick interpretation. Also, what we want to do is look for candlestick confirmation maybe on a shorter term time frame. If I'm looking for a trade on a 4-hour chart, I may then go to a 1-hour or a 15-minute chart to actually look for the execution. And furthermore, we say that we do not want to buy or sell, we don't want to sell in this case the Bollinger Bands if the market's trading at a new high. But we see here, the market broke to a new high. Here's that red line, that horizontal red line. We don't want to sell the market to the new high. We only want to sell if the market hits the upper band and fails to break to new highs. And that was not the case. I like to wait for candlesticks to close. This would hopefully have kept us out of the trade. On the other hand, the previous buy signal, nice double bottom pattern over here. We see the market went below the lower band, but we did not go to new lows. This was the excellent buy signal, around 145.90. The question is, what are the Bollinger Band settings? I always use the standard default settings that chart packages provide, and namely that would be 20 simple moving average and 2 standard deviations. If you plug in the Bollinger Bands, and I'll plug them in again, I hope you folks can see this. Insert indicators, there we go. So if I were to plug in the indicator, the Bollinger Bands, it automatically pulls up 20 periods, that's a 20 simple moving average, 2 standard deviations, closing price of the candlestick, that's the default, and the shift at 0. The shift is, it allows us to move the Bollinger Bands one way or the other according to a predetermined amount. I never use a shift though. Now, sometimes traders may use a different Bollinger Band setting. Sometimes I'll use a 3. If you find yourself trading with the Bollinger Bands and you find yourself taking too many trades, too many false signals, you may want to use a 3. I always like to use 2 because I think it's important to see the signals that other traders are seeing. But the fact of the matter is, if we're trading a very crazy currency pair, like the pound yen, or the Aussie Kiwi, or the Swiss yen, or something very, very volatile and kind of erratic, you may want to go to a 3 or a 2.5. Kind of interesting to see how the differences work out. But at any rate, what we're looking at over here, again, horizontal line on the pound dollar daily chart indicates that the market started to, or the ATR I should say, began to decline at an increased rate, indicating a greater chance the market was not going to break out to new highs, new lows. And we can see, well, the market did eventually break out. It's not a perfect system. I don't think any technical indicator will give us a perfect system. These technical indicators, they're only as smart as those who create them. And although the Bollinger Bands, I think, is an excellent indicator, alone, I don't think it's enough. You know, the foreign exchange market, like any market, is very, very dynamic. There are so many different reasons why the market moves, and there's so many different ways that the market can move. So what we want to do is understand that we use the Bollinger Bands, it's looking for volatility. It's trying to find volatility. Same as the ATR as well, but it's not a perfect system. The ATR and the Bollinger Bands, it does not know about non-farm payrolls. They do not know about Fed meetings. And it really doesn't know the difference between more or less volatile currency pairs aside from the actual indications that it gives us. So we have to sort of help out the indicators. We have to be able to take these indicators with a grain of salt and interpret them, you know, under the current conditions. And I think that is why human beings make the best traders. A computer program or a technical indicator is only as smart as the person who writes it. And we're a lot smarter than that. I'm going to go to a number of other currency pairs, but if there's anything in particular you'd like to see, please don't hesitate to let me know. We're going to try to find some nice examples. Every chart, again, is a little bit different. Here's the euro-dollar daily chart. And what we're looking at is the ATR was increasing to level about 228 on April 2nd. Remember, the pound dollar, the first declining ATR indication really was April 3rd. You'll notice a lot of these currency pairs not only tend to move together, but tend to act in a similar fashion. So again, the ATR is a little bit late to the game, so we want to give it a little bit of extra room. We draw a vertical line at a point where we think, okay, the market, and it's a little bit of subjective interpretation, but that's okay. We're smart traders. As the ATR definitely started to decline, we drew a red line. From that point moving forward, move to the 4-hour chart or a shorter term chart, and then we want to look to buy low, sell high, as long as the market does not make new significant highs or lows. And we can see the euro dollar, well, it did give us a signal over here. The Bollinger Bands were at 132.55. We sold off and eventually rallied up to around 133.34, about 80 pips higher. Then sold off. We slightly made new lows. I'll give you an idea of how much new lows, 131.25, and then moving to lows of 130.88. So just about 37 pips lower. Not too bad considering it's a 4-hour chart. Over about 130, what did I say? 130.90, 131, let's say. Give yourselves the benefit of the doubt. From 131, the market rallied all the way up to around 134. Not too bad. 4-hour charts give us a lot of room. The market eventually broke back to the downside. It's negligible whether or not we want to take this trade because we did, of course, close at a new high, but then quickly reverse back down. If we'd taken a short trade at 134, well, ideally you want to take profits in the middle. That's the most consistent spot to take profits. But eventually, the market did break down to 131.28. Can anyone else see my cursor moving? I want to make sure that I don't have any issues in my hand. I'm moving the cursor around, the mouse around. Does everybody see that moving around? Does anybody see that moving around, I should say? Cannot see it. Okay, I'll refresh the charts. Alrighty. Thank you for telling me, by the way. All right, I refreshed the camera, and I hope we can see the charts now. Now, excellent. Okay, please let me know. I'll refresh it. Now, you'll notice that the ATR continued to decline, and the market broke to new lows. Again, it's not a perfect system like any technical indicator. It's limited. What we're going to find here are very slow, annoying little trends that tend to make new lows and new highs. So you have to be very careful to wait for the right confirmation. And what I would say furthermore is use support and resistance. Use Fibonacci lines. Use trend lines. Triangle consolidation patterns. Things of that nature, because we really want to find the best spot to get in or out. But essentially, drawing this vertical line marks off the point that the market really starts to slow down. This was not an excellent signal. An excellent signal is when we reach a very significant high. Another approach to this is, hey, let's draw this trend line on the ATR, and we can say, hey, look at here. Notice the vertical line comes just a little bit after the peak. But notice this trend line gave us a nice signal. The ATR rising showed us that the market was going down and the candles were much, much bigger. As soon as the candlestick started to shrink, the ATR started to decline. Then we had this huge move up, and that's why we want to place protective stops above the highs and below the lows. The market eventually, like it or not, did break out. We went up to much, much higher highs, and then the ATR hit its peak. But notice the ATR did not make higher highs. That's also a sign of a little bit of divergence. As strong as this move was to the upside on the euro-dollar daily chart, going back to the last couple weeks in December, well, then we started to go down, and the ATR failed to make new highs. The ATR sold off. Notice how the market became more choppy, more range-bound. Can't see it very well on a daily chart, but I'm sure if we were looking at the 4-hour chart, we would say, hey, look at this. Look at this range-bound market. In fact, I'll do this exactly. What we'll do is we'll mark vertical lines here at the peaks of the ATRs. Yet another approach we can use. Whoops. I'm going to draw on the top of the chart. Does everybody understand this? I hope it is not too deceiving. Okay, we're marking off horizontal lines at the ATR peaks. And notice the market goes up, 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 and the ATR hit its significant high. Then the volatility starts to decrease, and using more of a buy low, sell high type of approach, I'll adjust this chart here so everyone can see. Take away the auto scroll. Becoming an expert in MT4 charts. So, whoops, and I just moved my line. But notice here, this horizontal line marks the peak of the ATR, and as the market continued forward, we see that although the trend still did sort of exist to the downside in this case, the range-bound approach tends to work better in these type of market conditions. Let me look to a Kiwi yen. I know that was a request. So let me look to the Kiwi yen. And there is also a question. Where is my Kiwi Forex crosses? I know I have Kiwi yen. Kiwi dollar. Dollar ZAR. Kiwi CAD. Am I missing the Kiwi yen? There it is. What I like about MT4 is you're able to throw in these templates. I put Bollinger Bands and ATR together. Now, how large are the stops? It's an excellent question. Let me go to a daily chart, by the way. The stops, I wish I could give you a physical number and say, always use a 200 pip stop or always use a 50 pip limit, but it's not really the case. Every currency pair and every trading day is a little bit different. But what I would say is theoretically what we want to do is place a protective stops above the swing highs, below the swing lows. Now, if we want a little bit more of a precise calculation, I would say use the ATR as well. Some traders will use the ATR or 3 times the ATR or 2 times the ATR. I haven't used this approach to a large extent, but I think it's something really, really worth practicing. Using the ATR as a stop, meaning that we see here, this is the Kiwi yen. The current ATR reading is around 140. That's about 140 pips from top to bottom. So if we use half of the daily ATR is around 140. If we use a half of that, which are on the 70 pip stop, that would probably keep us in most of the trades. Now, where do we place a 70 pip stop? If I decide to buy the Kiwi yen, I mean, after all, the daily chart shows us that the market looks like it's going to hold at this lower Bollinger Band. Does it matter if I buy 54.30 or 55.70? Yeah, it absolutely does. When we say use a 70 pip stop, just as an example, we want to use the 70 pip stop 70 pips below the lower band. Because if I buy 54.30, beautiful, I place a 70 pip stop below that. But if I buy 55.10, placing the 70 pip stop takes on a lot more risk. So I want to make sure that I place the protective stops below the lower band using the ATR methodology. Let's take a little bit of a zoom out on the Kiwi yen and try to discern the trade. Kiwi yen is a little bit of a tougher trade because what we're looking at over here is a very, very slow ATR range going back to around December of last year. But let's see if we can zoom in just a little bit here. Little bit more zoom out. Well, maybe that's too much. It's a really, I'll tell you, it's a tough currency pair to track with the ATR, but we'll try to do our best. Vertical line, we're going to draw. Look at the ATR here. Notice they hit a double top pattern, and then it significantly started to decline. We'll draw the line around here. Whoops, I always make that mistake. Draw that line. This line, just for your information's sake, is on January 30th on the daily chart. Notice how the ATR continued to go down, down, down. Now, let's mark the bottom of the ATR, give ourselves a couple extra days. Whoops, I did it again. If you draw the line at the bottom, it only comes up at the bottom. If you draw the line at the top, it comes in both. So these two red lines mark off the low volatility periods. Zooming out now to a 4-hour chart. Let's see if I can make this a little bit easier. Oops, that's not what I want. Chart auto scroll, okay. All right, here. Now, two vertical lines mark off the beginning and the end of the very, very slow ATR. Using a buy low, sell high approach, we're able to catch the range. Now, of course, not every single trade is going to work in our favor, and unfortunately, the market did break out. That's okay, though. We have to, sort of expect to get stopped out every once in a while. But the fact of the matter is, I think we were able to catch a lot more profitable trades as opposed to negative trades. Taking a look at the range bound market that ensued afterwards, 1, 2, 3, 4, maybe 5, I would say 4.5 reversals on these Bollinger Bands. What's the average range in these Bollinger Bands? That's 46.50 up to around 48.30, 48.50. That's about a 200 pip range. Well, we completed that range 5 times. That's about 1,000 pips. Let's say 4.5 times is about 900 pips. The market went from the low to high over and over again. What's interesting to note is, hey, if this was a real range-bound market, let me adjust my lines and see what the daily chart would have looked like if we had the foresight to look back and say, hey, I only want to capture this little range over here. That's the perfect buy low, sell high type of area we're looking for. Well, on a daily chart, what does the ATR look like? It looks like it is just continuing to decline and decline and decline. And that's essentially what we're looking for. These little range-bound markets occur when this line is declining. On the other side, if the market is increasing, if the ATR is increasing, we'll take this move higher. Let me refresh the charts. How does that sound? How does that look, I should say? Does that look any better? You should just see the chart now. Excellent, excellent. Okay, so notice over here, the beginning date was March 29th. The end date was April 7th. And we see here that the ATR continued to increase at a dramatic rate. We went from a level on the ATR of about 125 up to a peak around 163. So the average trading range went from 125 pips to around 163 pips from low to high every day. Now going back to the 4-hour chart, what would this have looked like? Well, that's what we see. Nice little range-bound pocket. Oh, I'm sorry, I misspoke. What are we looking at this time? The ATR is inclining this time. More of a chance of a breakout. The candlesticks are progressively getting bigger and bigger. I like to make the analogy for those of us that are, well, baseball fans. Baseball is a very, very easy analogy. If we're watching a baseball team like the Boston Red Sox or the New York Yankees or whatever it may be, and if you were to track the average number of runs that they score, or if we're soccer fans, the average number of goals that they score, and you create a little bit of a moving average, we would say, well, my baseball team averages around 4 runs per game, 4.5 runs per game. And then we track the next month. The first month of baseball is April. Second month in May. In May, they score 3.5 runs per game. In June, 5.5. In July, 7.5. We would see that team, that sporting team, is continuing to increase the number of runs it's scoring, showing a better performance. Well, the same holds true, I think, with technical analysis. Specifically, as the ATR is increasing, it's showing us that every single day that goes by, generally speaking, the market continues to get more and more volatile. This inclining ATR shows us don't use a buy low, sell high approach, but rather use a breakout strategy. Now remember, if we want to sell short at the upper band and buy the lower band as long as the market does not make a new high, what would a breakout strategy look like? I love breakout strategies. The breakout strategy is the opposite. We want to wait for a candlestick to close at a new high, and we also want to see the candlestick above, hopefully close above the upper line. That did in fact occur. This closing candlestick, this was April 2nd. Remember April 2nd, April 3rd? It was a big day for Wall Street, I guess. 56.70, the market broke to new highs, eventually hitting highs, 56.70 up to 60.30, almost 300 pip move in a few trading days. This, again, is using the opposite approach, looking for breakouts when the market is above the highs and then above the upper band, or in the opposite case, below the lower band and below new lows or at new lows. If there are any other currency pairs you'd like to see, please don't hesitate to chat them in. If not, I have a number to look at as well. Dollar Swissy, you may ask, what is happening right now? Dollar Swissy is giving us a nice signal. Taking a look at the ATR, draw a line. I did it again. Whoops. Let me insert the ATR one more time. Average true range, 14 periods. There we go. Now, drawing a vertical line at the peak of the ATR until current dates. The peak of the ATR occurred most recently around April 17th or so. This is a 4-hour chart. Let's go to a daily chart first of all, see if we can get a better indication. Zooming out daily chart, what did the ATR look like? Well, we hit a peak going back to March 19th. We went down, up, but let's use March 19th just for argument's sake. Now, 4-hour chart, zooming out. We see here a nice little range-bound pocket ensued very, very shortly after the ATR hit its high. And this is what we're looking for. This is the beautiful range-bound market that occurs. 4-hour chart, lower band, upper band, over and over again. The lower band was a level on 112, the upper band 113. That's a nice 100 pip range. Dollar Swissy is usually considered a pretty quiet currency pair, but when you have a 100 pip range in the Bollinger Bands, and we tend to reverse every 24 hours, every 12 hours or so, it presents a very nice opportunity. Again, if there's any currency pairs you'd like to see, I have the dollar ZAR. I don't know how good that's going to be on this strategy, but we'll take a look. Here's the dollar CAD. Look at the ATR continuing to go down. Now let's pretend for a second, let's throw away the 4-hour charts. Let's say we just want to keep things simple. We just want to stick with the daily chart. Well, the daily charts hit that very, very significant high, remember back in October, and then just started to move to the downside and continued at a very nice clip. As the ATR continued to decline, so did the market's volatility. And we're drawing a vertical line at the top of the volatility over here. Again, in this type of approach, we just stick with the daily charts. That's also okay. I prefer to move the 4-hour charts to look for a little bit more frequent trading opportunities with the strategy, but we can always use the daily charts as well. The daily chart shows ATR hit this peak back in November of last year, and then using the Bollinger Bands, not too bad. Selling short near the highs, 129, 130. Going long near the lows, those lows are near 118, 119. That's about 1,000 pip range. Again, I would prefer to take profits at the center moving average, but notice as the ATR and the dollar Swissy continued to decline over and over again, the market did not break out to new highs and new lows. Now you may notice that the ATR did cross above its own trend line as the market went to slightly new highs, but I think it still shows quite a bit of divergence because the market is certainly continues to move to the downside. And as far as the dollar CAD is concerned, with this chart, I would continue to use a buy low, sell high type of approach. There's a great question. I'm going to get to the dollar NOK and the dollar ZAR in just a sec, but there's a great question. If the ATR peaks and then falls, can we say the rally is near the peak? If I understand your question correctly, After the ATR is going up a lot, do we expect it to go down, or Jack, am I missing a question? If ATR peaks and falls, can we say the rally is near the peak? The ATR, it's a great question. Maybe I should have read the question more carefully. When the ATR hits significant highs, it basically tells us it's not a directional indicator. The ATR just measures the average trading range of the candles. Now, the ATR does not know if the candles are going up or going down. It just simply knows that the average range is increasing or decreasing. If I were to look at the dollar CAD and zoom in, let's go through this exercise. Today's candlestick, the low 123.55, the high 124.57, that's around 102 pip range for the day. Yesterday, 123.25 to 125.20, around 75 pips. The day before that, 121.21 to 124 almost. That's around 350 pips. So we had 100 plus 75 plus 350. That's 450, 525 divided by 3. That gives us an average trading range. I would say about 75 pip, no, I'm sorry, what, 500 divided by 3, about 200, about 150, 175 pips if we were only to measure the last 3 candlesticks. But the ATR does not know whether the market's going up or down. Case in point, notice a large red candlestick over here. This is on April 2nd, dollar CAD daily chart. April 2nd, the dollar CAD went down a lot. And then notice the ATR spiked to the upside. That was the market moving down. Now, further on down the road, a couple days ago, we had a very big move to the upside, April 20th. And the ATR line also spiked higher. See how the ATR line tends to follow these other indicators, follow the price action, so to speak? It's because the ATR measures 14 previous candles. So it takes some time for the ATR to catch up to what the market's doing. Use ATR value for some. We mentioned this earlier. Some traders do. I particularly don't, but it is a good idea. I think it's a logical idea. What we mean, again, is you take a look at the dollar CAD, ATR currently is around 137 pips. Let's say 140 to make the math easy. Well, if I said I want to use half of the current ATR as my stop, 140 divided by 2 gives us around a 70 pip stop order. So yeah, I would use that. 70 pips below the lows or 70 pips above the highs. Let's see if I find the dollar note. But yeah, I do like that ATR using for a stop value. I do like that. Let's see here, dollar X, dollar Hong Kong. There we go. Daily charts. Well, we hit that very, very significant high. We know back November of last year, all the charts look the same. And notice how the market just continues the downside. So we mark off vertical lines. I love doing this. At the highs and lows, whoops, I did it again. Just like the song. Notice as the ATR is declining, the market's range bound. Then the market breaks to a little bit of a new low, sending the ATR higher. Then we have this range bound market ensue, noted by the ATR. And look what we have here. A range bound market on the ATR and a fairly range bound market on the daily charts. But notice now the ATR has really begun to sell off to the downside. That shows us even more of a possibility of range bound markets to continue. So in terms of the dollar NOK, what I would say is that the dollar NOK, as they call it, is that I would continue to expect range bound markets. Coincidentally or not, we actually see the market very, very close to the upper band at the moment. And that's what we're looking for. But before I forget, and before we run out of time, let's go to the dollar ZAR. Dollar South African Rand. Plug in my little nifty template here. Daily chart shows us that very, very significant peak. That's when the dollar, it's not so much a South African Rand move as much as it is a move dictated by the entire market. That's when the dollar went up, 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 up as a flight to safety. But eventually, the market returned back to the downside. The ATR returned back to the downside. I did it again. And the market continued to go down, 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 down. If we were to draw some sort of trend line, we would see, hey, the market and the ATR hit a very significant low, and now we have more of a chance of breakouts to ensue. And looking at a 4-hour chart, I'm sure we've been able to see quite a few breakouts. Zooming on the daily chart, though, we can see the market just continues to hit lower and lower lows. If you'll notice, no matter what charts we're looking at, euro dollar, pound dollar we look at, the dollar, Swissy dollar, CAD dollar, NOK dollar, ZAR, all of these markets have continued to slow down, slow down, slow down. So dollar, ZAR in particular, let's see when the ATR really started to move down, and that was marked off by its peak. That date, right around March 13th, going to a 4-hour chart. Oh, you can barely see the red line over here, but we see more range-bound markets ensue. I have other charts. Dollar, no, this is the Aussie dollar. Why is it that the ATR and these lines tend to look very, very similar? Because the foreign exchange market, there's no stock that's independent of the rest. You know, every currency is tied into another currency one way or the other. We take our 8 major currencies, the dollar, Swissy, yen, euro, pound, Swissy, Aussie, Kiwi, CAD. What we're looking at are 8 of the major currencies. But these currencies can be divided into little subsections. Flight to safety, that could be the Swissy or the yen or the dollar. The more speculative currencies, the higher interest rate bearing currencies like the Aussie and the Kiwi, or it used to be the British pound. So we can dissect the market, but if capital comes out of the pound, capital has to be moved into another currency. It's literally impossible to own capital that's not denominated in one currency or another. Even if we decide to buy oil, crude oil, or gold, well, we have to use currency to do so. Let's see, the SGD, these are currency pairs. If you see it, please let me know. I don't see it. I do see it. I almost gave up. Daily chart, this makes it a little bit easier. SGD, it's hard to say. ATR hit a very, very significant peak going back to March 19th this past year. The ATR was at around 135, around 135 pip trading range. Notice how the ATR continues to go down, down, down. Well, from that point moving forward, 4-hour chart tells us the zoom out. 4-hour chart also tells us buy low, sell high, buy low, sell high. And I think you'll notice that after the market has made a big, big move up, well, we could logically expect a big reversal. But after that big reversal, that 1-2 punch, then you really expect markets to slow down. And that's exactly what we're looking at. So as far as the dollar SGD, we continue to see range-bound markets, and I really like a buy low, sell high approach. We can always use the RSI or the MACD or other indicators to confirm our trades, but more importantly than that, indicator list, delete. I'm going to delete this one also. Let's say we didn't know any better. Looking at the daily charts, zooming out, uptrending support, resistance, possibly as follows. But we see large range-bound markets. Going to a 4-hour chart, shorter range-bound markets also do exist. And using, again, a very simple buy low, sell high approach, when the ATR tells us to do so, I think can be a very effective way to trade. The reason why I think this is very timely is because we had huge moves last year. We've had very big moves this year. If you were to ask me my personal prediction for the stock market, my personal prediction for the foreign exchange market, is I think everything will continue to sell off. There was a big move down and then a big move up, and we're looking for the buyers and sellers to slowly just give up their control, and then the market establishes a range. With that said, I think we're just about out of time, but if you have any questions, do not hesitate to contact me directly, www.forexlounge.com. We have live trading sessions throughout the European, US, and Asian hours, and drive trading signals delivered to your cell phone via SMS. Contact me there, www.forexlounge.com. I thank you all very, very much again for joining us. Always a pleasure. Thank you, very special thank you to FX Street for hosting this webinar. Please see the calendar. We'll be back on later on this month. We wish you a great day, all profitable trades, and we certainly look forward to seeing you back soon.